You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it's time once again for Options Playbook Radio, the program here on the network where we break down the sometimes scary, sometimes just intimidating world of options into some easily understandable offensive and defensive plays that you can utilize in your own portfolio. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Hope you guys are enjoying the slew of content that's been hitting the network recently from all the various conferences and events. I talked to a lot of people just for your own edification, so I hope you guys are enjoying all that out there. But if you're saying to yourself, wait a minute, what's that guy doing on this show? This is not his show. You are correct. So allow me to introduce the actual host of this program, Mr. Brian Overby, the senior options analyst, a.k.a. the options guy over there at Ally Invest. Brian, welcome back to your own program, sir.
Always great to be back, Mark, and I always love when you can take some time to get on and help me out with the show, because that means it's time to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody, welcome to the huddle. Like the man said, this is the portion of the show where Brian and I put our heads together and we try to answer some of your interesting, impressive, sometimes curveball options questions. We love what you guys throw at us. Keep them coming. Let's see how many we can squeeze into today. Let's kick things off. The question from Chickenluvr. Man likes himself some chicken, but he also wants to know about open interest. He says, do you know if there is any way you could tell if positions are being opened or closed intraday? So sort of a live options open interest. Brian, this is an interesting question. Well, it's actually kind of timely. I'll get to that in a little bit. But this is also a question we receive, you guys probably do at Trade King a lot as well, on a regular basis. You know, people, particularly on the retail side, they've been trained over time to be able to hit a bid and lift an offer in the world of options, and the trade is done in milliseconds, you know? So they see the execution happening that fast, and then they wonder, how come the open interest isn't updating with a similar degree of speed? So first off, Brian, I'll let you maybe give the short answer to this one. Then I have a little bit more maybe nuanced answer I can go into, which is kind of timely.
All right. Well, in general, you need to know what open interest is, and it's the number of option contracts that have been written or are open on that particular strike in that particular expiration. Now, that information is just totaled at the end of the day, and it's part of the reason why when you enter option orders, you mark those tickets buy to open, buy to close, sell to open, sell to close, because the exchange looks at all the tickets that are marked opening versus all the tickets that are marked closing, and they can see, did the open interest increase overnight or did it decrease overnight? And they do have the possibility of, from talking to some of the exchanges, of doing it intraday, but they choose not to. And one of the reasons why people ask this question is they would like to know more so, are these orders that are coming to the market, that 1,000 lot that we saw trade, did that just, were they buying that option to open, or were they buying that option to close a covered call? They would like to try to figure that out a little bit more. And if you have an active open interest number that's updating every 10, 15 minutes in the marketplace, it's a little bit easier to discern when the big orders come into the marketplace. That's the main reason why a lot of people like to ask. But as of right now, it's only done once a day.
Yes, this is a popular question. In fact, so popular that when I was down at OIC last week, I actually put this question to the CEO of the Options Clearing Corp, aka the folks who would have to do this, who put out the open interest numbers and update it every day. And he kind of gave an interesting answer. I'll encourage you to check out that interview when it hits the network so you can hear his words for himself. But he kind of implied there's a lot of different moving parts to this. First off, it's the technology side of it. And for them, they're in the middle of I think a 2 to 3 year overhaul they're calling Renaissance. So the tech side isn't really there yet to be able to do this and match up the orders intraday. And also there's a little bit of an institutional pushback. Not all the big firms out there want you knowing exactly if they're opening and closing instantaneously out there. And also there's some other issues with some outstanding orders. You can really never get it to sum up that easily instantly. There's always some outstanding questions about things along those lines. So I kind of put it to him, maybe instead of having instantaneous, which sounds like it's maybe a bit of a bridge too far, maybe having more frequent updates instead, like maybe a midday open interest update and then an end of day like we kind of have now instead of the once a day. And he seemed like that might be a little bit more viable. Again, I would encourage you, check out my interview with the CEO of OCC to hear it all for yourself. Hitting the network forthwith if it isn't up there already, and you can hear it all for yourself. But there is some movement on this, but not a ton. So don't expect, unfortunately, instantaneous OI updates anytime soon. But they are in the process of overhauling the infrastructure, and when that happens in the next year or two, it might be in a better position to maybe, hopefully, make Chickenluvr and everyone else's out there's requests for this, make it at least come a little bit closer, maybe like a midday update, something like that. All right, Meravol up next. Meravol wants to know, what are your thoughts about selling strangles at the first standard deviation levels of a particular stock, sort of like a Bollinger Band strangle? What are your thoughts on this technique? Is it me, or are there new techniques for selling strangles all the time that always tend to blow out? Aren't you better off selling iron condor or looks like an iron butterfly due to limited risk? Yeah, you're right, Meravol. It does seem like there are new ways to sell premium all the time. A lot of it is in what you're talking about. I haven't seen this particular strategy in a while, but it has been put out there before. It makes sense. What's the Bollinger Band? It's effectively the most basic version of it is, one standard deviation up and down. It would make sense if you buy into that methodology to want to sell a strangle, maybe at that level if you think the stock is going to be banded by those actual bands there. And then, of course, but the issues with it are kind of what you point out. There's naked risk, your naked short units, not just to the upside, but to the upside and the downside. So that could be a little bit dangerous. And I do agree with you that it does seem like there are new techniques for selling strangles and related strategies all the time. We could probably do multiple shows on it. We don't. Instead, we just answer your question. Brian, what are your thoughts here on Meravol's? What are your thoughts in general maybe on that technique first of selling the, I guess what he's calling the Bollinger Band strangle? A, do you like that? B, do you prefer the more mitigated risk of an iron condor and iron fly? I have a feeling I know how you're going to go, but I'll let you say it for yourself. And then C, the third part of his question, the third corollary, do you agree that it seems like there are new techniques for selling strangles out there all the time, and most of them tend to just blow out?
Well, all right. Yeah, there's a lot in that one question. That's,
a lot to unpack there, sir.
Yeah, an entire day's worth of seminar if you want to try to explain exactly the question overall. But with that said, the concept here is that if you look at one standard deviation move, and we're going to just assume the simple math, the simple bell-shaped curve, you got a 68% chance that the underlying stock will stay within a certain range. And that's what we're talking about by doing a strangle. You're selling just outside of the range, on the call side and just outside of the range on the put side, assuming that 68% of the time the market's going to stay within that one standard deviation move. Now, here's the thing that doesn't get talked about a lot is that, yes, if you're looking at a one standard deviation move, that means there's a 16% chance it could go above and put the call in the money, 16% chance that it could go below and put the put in the money. But those are at expiration dates. And the biggest thing about that is if you're saying at expiration, that means that you're just going to hold this forever. And if it goes deep in the money, there's still a chance it could come back and finish out of the money. So the probability that doesn't get discussed that much is the probability of touching. And usually, if you look at any probability calculator, we just always did the rough and dirty math back in the day, when all the brokerage firms didn't have all these fancy tools. But it's usually about double. So if there's a 16% chance that it's going to expire worthless at expiration, there's a 32% chance that it's going to at least touch that strike over the life of the option contract. So you got that on both sides, of the gamut. You got that down on the put side. You got that down on the upside. So, yes, there's always a good chance for it to come down and at some point in time be a loser on your trade. And I think that's one of the things that doesn't get talked about as much as the probability of it actually finishing at the expiration date. So, would you be better off doing the iron condor or iron butterfly? I would always feel better doing that. If not, that means you got to manage your risk nonstop. And a lot of people, the biggest thing that they're looking at, or the risk that they're talking about, is overnight risk that's almost impossible to manage. And that's why a lot of people, if they're doing this, they'll do it on the indexes, because you don't usually get the huge 5 or 6% open in the S&P 500 just because of a major news event overnight. Now, is it possible? Yeah, it is. It just doesn't happen as much in indexes as it can happen in stocks. So I always feel better doing an iron condor or an iron butterfly for those events, particularly on the open, that you can't always protect against if you're watching it during the day. So are there always new ways to sell these straddles and strangles? Yes, everybody always seems to try to come up with a new way to do it. But really, if you're going to do it, you need to have a plan, and you need to stick to the plan. And it's amazing how hard it is for iron condor traders to take a loss, or not just even short strangle traders, to take a loss when they initially said on the trade, this is where I'm going to take my loss. It just doesn't seem like they can pull the trigger for some reason. And then all of a sudden, a bad trade turns into a worse trade. So because of that last reason, all by itself, I think most people, especially starting out, should be in iron condors and iron butterflies if you like the concept of selling options one standard deviation away.
Yeah, it's hard to get behind just getting out there and naked blasting out short units to the upside and to the downside. What could be wrong with that, Brian? What could possibly go wrong with that? So yes, I think we agree, Mr. Meravol here, that we definitely prefer the more mitigated risk approach. And you're right, there are new techniques for this kind of everything old is new again. Everything I've joked before, the simple short put, it's got a whole new life in the last couple of years. So much data and research coming out about harvesting the quote unquote risk premium. Like this is a new strategy when it's been around for decades. So everything old is new again. And there's always an old flavor, I should say, of strangle selling that becomes new again because someone rediscovers it. And maybe it's now the time for the Bollinger. Maybe you coined a new phrase, the Bollinger strangle. I like that. All right, let's keep rolling. We got similar questions here from S Warz, and Thankfulness. I like that last handle, Thankfulness. They both want to know about dark pools. S Warz wants to know, can you trade options through dark pools? And Thankfulness just wants to know, do you have dark pool access? Meaning, I guess, me personally, or Brian in this case. The answer to both of these is going to be no. The short answer, the longer answer is a little bit more nuanced than that. But quite frankly, options, there really aren't any quote-unquote options dark pools like you see in the equity space. Equity space, upwards of half of the volume is executed in those quote-unquote dark pools, actually venues that are controlled by these other firms that are outside of the exchanges. There's a lot of controversy about that. The name alone is kind of ominous when you think about it. But we don't have that in the option space for a simple reason that there's effectively an exchange execution, an exchange printing requirement that goes in here. So that when options trades go up, they have to be printed, quote unquote. They have to be actually executed on the floor. I use floor in quotes because the floor is usually virtual now, but on the floor of an exchange. And that's relatively unique for the options space. That doesn't mean the trades aren't all but executed off the floor. I mean, if you have a big institutional block order, it's going to get shopped around for a while. They're going to find a counterparty to buy it and match up on the sell side. So it's going to be all but executed by the time it gets to the floor. It'll be wrapped up with a nice little bow in a package and be ready just to be stamped and printed on the floor, but still has to be printed there. You're not going to see that happen in the option space outside of some very, very alternate venues like, the stuff that Tony Sliva built back in the day over there at Liquid Point, which was kind of effectively a bit of an ATS for options, aka a mini options dark pool, but they don't really like to use that terminology. But still, it's a very interesting gray area, a lot of colors in this one. Brian, any thoughts at all on for S Warz and Thankfulness on the fun or lack thereof, I should say, for options and dark pools?
Well, if they find the dark pool, please send me an email. That would be about all that I got.
There you go. You don't have the big Ally dark pool for options running right now, just printing things left and right that nobody knows about. Secret dark pool.
No, but it is an interesting world in the stock world. But as far as I know, there is not a dark pool. But that doesn't mean it doesn't exist. Maybe it is out there somewhere, but I've never heard of one, and never. And you don't even really see any information on it. If you Google it, it doesn't really talk much. Nothing really comes up. So, Google. If you Google something and there's no conversations on it, it must not exist, right?
There you go. If it's not in Google, it doesn't exist. Yeah. It can't possibly exist, sir. All right, let's see. We got more here. Brian, we could do questions for about 5 hours. You got 5 hours set aside for our listeners here?
Of course. Are you ready to go? Let's do it.
Let's keep rolling. We'll do a few more. I don't know about 5 hours, but we could easily go that, man, with how many we get here. Let's see. Mr. Petty. Hopefully he's not a Petty person. Maybe he's just a fan of Tom Petty. But Mr. Petty wants to know, what is the sweet spot when buying options when it comes to time decay? I don't want weeklies, but I also don't want to spend a fortune for a 2-year option. Brian, it's so funny how some of these questions that are seemingly simple to the person who writes them in can be so nuanced and have so many layers to them. This one alone could probably be several hours worth of discussion here. I think the interesting thing about it is if you ask 10 different options pros, they may give you 10 different answers about what they feel to them is the sweet spot for options time decay. So, Brian, I have an interesting answer to this one, but I'm gonna let you go first, so I don't color your perspective, sir. And then I'll see what you say, and then I'll jump in to see if I agree or not. I'm just kidding.
Well, I love the name The Sweet Spot because that's the name of my boat. But
there you go.
With that being said, when you're buying options, there are sweet spots, and I do agree with that. But it's more so about the dynamics of that underlying, and we talk about that a lot, especially around earnings. Our good old skip strike butterfly that we've done around earnings, our back spreads, all you think very hard about what expiration you want to choose. And it's more so about what's going to happen if implied volatility comes in after the announcement and as the expiration is approaching. So in general, is there just a sweet spot? Is there a golden book of answers on buying an underlying? I'm going to say no. I'm going to give a couple of general rules that I think I would follow, though. If I'm buying out of the money options, I will buy more time. I don't necessarily care when I'm looking at in the money option contracts if I'm buying long-term or short-term. It doesn't matter as much to me because I'm getting so much more real value, intrinsic value. It's more so on what my forecast is and when I think it's going to move. But if I'm buying out of the money options, I will always err to the side of buying too much time as opposed to not enough. And one of the things that's very interesting is when you get into the delta of out of the money option contracts. Let's say we stay on the same strike line, but if I go further and further out in time, I actually get more and more delta. my delta increases, because if you think of delta as probability, the probability of it finishing in the money actually goes up if I give it more time on the same strike line across all expirations. So I would rather get more delta, and I'd also rather have a slower rate of time decay. So out of the money options, I'm going to look 3 to 4 months out, even though I might have a shorter term forecast. And that's really about the only rule that I could give to you, is that I would rather do that on out of the money options, add more time, because I also get more delta. But then again, I do got to pay for the time. So it's a little bit of a trade-off.
It is that sweet spot, not to borrow the name of your boat again there. But people ask this a lot. You know, they ask for like hard data on this, and there isn't a lot of hard data. The one study I do tend to refer people to, maybe Brian, you've seen this one as well. It's a study the OCC did a few years ago on collars. And in particular, it started off on the Qs. It was called Collaring the Qs, and they expanded it to a variety of different underlyings, you know, gold, indices, all these kind of things. And one of the interesting things they did is, you know, they played with the collar a bit to see, because the collar, obviously, listeners, has a long component and a short component. In particular, you're buying a put, and then typically you're selling an out-of-the-money covered call. So that long component became how the collar performed was very much fixated on how and where you ended up buying that put. And they experimented with a lot of different areas. Obviously, as our listener says, you can go out very far, end up paying a lot, but for a lot of time. And so you could probably end up dramatically overpaying for effectively the amount of bang for your buck you're getting on that option is maybe not a lot compared to what you're paying for. And on the opposite, if you go in the weeklies or even in the monthly, it's going to decay to zero. What they found in that study, which I've kind of found to be a decent sweet spot for me as well, is somewhere, they like 6 months. That could be a little bit long for people, but somewhere in that 3 to 6 month time frame seems to be that quote unquote sweet spot you're looking for. And obviously it's going to change depending on month. It's going to change depending on where you are, like Brian alluded to, how far out of the money, if you're going in the money. All these, there's nuances to this. That's why there's no hard and fast rule. But I think if you look somewhere in that 3 to 6 month time frame, it's pretty good. Now, if you go a little bit farther out to like that 6 month area, then you might want to consider maybe rolling when you get down to about that 3 month period, back out to the 6 months. Because A, you'll still have a decent amount of meat on those bones. It won't have decayed a lot yet in that 3 month period. And then B, once you get into that last kind of 3 months of that option's life, it's going to start decaying. So if you don't want to experience that, you want to have that sweet spot. Maybe 6 months with rolling every 3 months. That seems to be a decent answer there. And that's the one that has actually some data behind it. Check out those studies, listeners. It's called Collaring the Q. They actually just did an update with it. I talked to them, the OIC folks, about it down at the conference a couple weeks ago. So look for that little chat we have on the network coming soon where they've updated that study a bit. But it's an interesting one. It's one of the few bits of hard data I've seen actually trying to answer this question. But again, it's highly subjective, and everyone has a different view on what's worth it. So there's no hard and fast rule, but if you had to pick one, I think somewhere in that 3 to 6 month time frame seems to be pretty good, maybe with the added corollary of rolling when you get down to around that 3 month level. All right, we got time. Brian, we always like to end on some love, right? So let's end with some love here. Let's go here. Who we got here? Tenasur. I like interesting handles this week. Tenasur wants to know, he's got some love for us. He says, Ally is smart. Ally is smart having a show on this network. It puts them ahead of a lot of brokers that are still figuring out their content strategy. Maybe one day Ally will pick up the rest of it and make it the Ally Options Insider Radio Network. That would be pretty sweet for Ally clients to have access to this stuff 24/7, although the rest of Mark's listeners might be a little angry. Well, I agree with you. They are pretty smart, and they've been doing this for a few years now. So they were pretty early when it came to the content space. The rest of it, that's an interesting idea. It's not one we've discussed, not one certainly that is top of mind for us, but it is interesting to see kind of how people are approaching this space these days and how, quite frankly, what we're doing here on this show has become very central to this space in general, finding ways to engage with you guys, finding ways to keep you guys engaged with the platform, keeping you guys thinking about active, healthy, smart, safe ways to trade. These are all beneficial things. If you take a brokerage customer and let him just kind of sit out there and twiddle his thumbs and do his own thing, you're not giving him the best experience. You're not helping him along that journey. And so content like this, it educates, it informs, it engages. Hopefully you find us a little bit entertaining. Maybe me, I don't know, I can't speak for Brian, but hopefully me at least. And then good stuff. So Brian, what do you think? A little bit of love from the fan base is always nice.
Yes, it is, without a doubt. And yeah, why not? Why not? We should be doing more of this, and I enjoy doing it so much, and especially when we can get together and hear a little bit of love. And the fact that this day and age, the ability to send us questions and to keep up with the listeners is just so simple with all the social media. So, yeah, thank you so much for the comments, and maybe it's an idea we got to float around.
Now, Brian, we've come to the hard part of the show. You thought I forgot, but I didn't. We have to pick a winner. Who wins the playbook this week, sir?
Well, we can't give it just to the love.
Yeah, that's true. Right? It would be nice to give it to the love, but so we've got Chickenluvr, Meravol, S Warz, Thankfulness, Mr. Petty, and Tenasur.
I like Meravol. First of all, Vol is in the username, and that's a big theme recently. But I just thought it was a very interesting question and gave the opportunity to talk about probability of touching versus finishing. And I think that was a fun question to answer, so I really appreciate that. Thank you, Meravol, and we'll get the playbook out to you as soon as possible.
There you go, Meravol. A playbook coming your way. And Brian, if other folks out there want to be like Meravol or the rest of the crew here, they want to get their question answered live on the show, and maybe they win a prize or two, where should they go? What should they do, sir?
Well, if all else fails you can always just send an email directly to me at theoptionsguy@invest.ally.com. And that'll be it for this show. So thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish into money. Now the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.